Welcome to the Financial Fortune Teller podcast. Here with me, Mark Seddon of Fortune Financial, and today I'm joined by Cade Somerville,
Hello.
our senior mortgage advisor. Welcome, Cade.
Thank you very much. Good to be here.
It's been a long time waiting, hasn't it? Because I thought we'd have got you on first, and I think this is number 3.
Third one, yeah. I don't mind waiting. That's fine. I don't mind coming in third.
Is it going to be worth the wait?
Absolutely.
Well, of course, you're a senior mortgage advisor. So today we're talking all things mortgages. So if you're from the Hitchin and surrounding area, of course, if you're nationwide and you want to get in touch, we're more than happy to help. But of course, we're here to give you some bespoke, simplified advice on 2025, where we're heading with regards to the mortgage market.
Yep.
And also, I'm a big believer that, if you look back when you're trying to move forward, you can trip up. But at the same time, glancing back now and again is important. So let's glance back at 2024.
Yeah.
And we'll see where we've come from, and we'll see where we are at the moment. We'll see where we're heading, some projections, and we'll enjoy a little bit of a chit chat of the mortgage industry.
Absolutely.
So before we get going, we always start with Pen Watch. So this week we've brought Santander. We've got a Santander pen. Santander is one of our mortgage lenders. I'm sure you've heard of them. Of course, there's many other mortgage lenders available. If you do want to choose a lender that's right for you. But yeah, Pen Watch, Santander. So we'll tag you in the post. Hopefully you can give us a little like. And hopefully we can get you on the podcast at some point.
Maybe get some more pens as well.
Yeah, exactly that. Yeah. But there's nothing better than a little bit of memorabilia. I think that's what we're kind of hinting at here within these podcasts. Is that whether it's a pen,
get the message,
whether it's a pad, whether it's a mug, we'll have anything. So if you're a provider, you're a lender.
Absolutely.
We will...
very grateful.
We're very grateful. Absolutely. So mortgages. So
I'm
going to hand the chit chat over to you initially and ask you a really simple question.
Go for it.
It's 2025. Where are we currently at with regards to mortgage rates, the overall feeling of the mortgage market, and you're dealing with clients day in, day out. What's people's perception, and what are you telling people at the moment by means of mortgages?
Okay, so really good question. I think this will be music to a lot of people's ears. Right now, it's really good. It's really, really good. The mortgage market, it feels like it's booming again. Estate agents are saying the same thing. They're getting lots of positivity from people looking to go back to market or maybe put it off from last year, looking to sell houses. So that helps obviously with stock and demand of properties. That's really good. But I mean, the big topic, interest rates. And that right now, we're in a really, really good place.
Well, let me stop you there. And sorry to stop you.
Oh, no.
But you just said things are really good.
Yeah.
So my initial feeling, there's a lot of people watching probably are, is that how can things be good?
Yeah.
We've come from a 300-year all-time low of interest rates, below 1%, which was a freak, post-pandemic occurrence, shall we call it. And interest rates have been significantly higher.
Yeah.
So can you explain? Because that's what people will want to know.
what does good mean? By that? I refer to simply, if we go back maybe 6 to 9 months, where interest rates were creeping up. So we're sort of talking maybe summer to winter last year. Interest rates were increasing. They were going up, and we were probably experiencing more sort of the mid 4s to late 4% deals. And that, listen, if you go back 10 years, 15, 20 years, rates were 11%, right? So we've got it good. Let's be honest with that. But yes, I suppose you're referring to 5 years ago in that COVID period where, we could get a 0.99%. Okay, they were the best times ever, right? But we're not going to see that again, I don't think, in a very long time. So what I mean by good now is we've actually seen a couple of lenders come to market with a sub 4% mortgage.
Wow, yeah.
Okay, and that
feels a bit nice.
Yeah, it just feels good. That's why it feels good. It feels good. So people in the market, whatever you're doing, first time buyer, home mover, or remortgaging, there's some really good deals out there to be had, and it just feels good. And what also sort of contributes to that feeling for me, like I said, with the estate agents, that's one thing. So we get a good vibe from them. But in addition to that is that it's competitive. And that's the key for the mortgage market, in my opinion, is that we need lenders to be competitive because they will drive each other down. And that's how rates continue to come down. And that's what we're seeing. So we're seeing a good level of competitiveness in the market as well.
So what I gauge from that is that we are back to normal.
A little bit, yeah, absolutely. A little bit. There's a lot going on with interest rates and with the economy, with inflation. So there's some good feeling out there. Listen, there'll be lots of different things you can read in the media in regard to how the economy is doing and how inflation is doing, but specifically the mortgages, that's what we're here to talk about. It's a feel-good factor right now. I feel like we're on a path where interest rates are going to continue to get better.
Okay, so we're talking about interest rates slightly improving. We're talking about with potential for them to get better. Do you feel it's a good thing then for people to be going out buying houses now, especially a first-time buyer, or even people looking for a new mortgage product as an existing mortgage client, customer, shall we say? Do you think it's a good time to obtain a mortgage rate, or should it be a waiting game?
So I suppose I'll answer that in two separate sections, because you've got someone who, like a first-time buyer, for example, like you said, who's looking to buy a home. The right time isn't necessarily dependent on what mortgage rates are doing. I suppose it comes down to the individual more so.
Yeah.
Is it the right time for you? And speaking with a broker, you'll be able to really understand that from a financial aspect, I suppose, and saying, well, this is where interest rates are now. Yeah. Does this financially make sense for you? Yeah. So it's more about your personal circumstances, more than saying, is it the right time because where interest rates are? Is it the right time for you? Yeah. The second part of that was remortgaging. That's a whole different way to look at it, because you don't have the luxury of sitting and waiting. You might be on a fixed rate deal that's coming to the end of its fixed rate period, and that's creeping up on you. So you've got to deal with that. You've got to do something with that, which is obviously what we're here to do and help with. So yeah, waiting maybe not the right thing in that instance.
Could you just elaborate for me on that then? So we'll still stick with the existing clients. If someone's got a current product with the likes of a lender like we mentioned, and that was fixed in for a period of 2 years, 3 years, maybe 5 years. Yeah. If that product is coming to an end, should they not wait? Should they not hold back? Or should they be proactive and be looking for a new rate, understanding where they're heading? What kind of advice would you be?
It's a really great question, because I get lots of different responses from clients when existing mortgage holders, and where we've got that better feeling of interest rates coming down, their feeling might be, oh, do we sit tight and wait for a better rate? My opinion, my advice would be no, because like you said, you've got a fixed rate, or you've got a product of some form, whether it's a fixed rate, a variable, or we'll come on to some other types later, but that product will have a specific period of time that you'll be on it, and it will be coming to an end. So we need to get ahead of it. So we always recommend 6 months, if not 7, prior to the end of your fixed rate, have that conversation. So speak to a broker, speak to Fortune Financial, and we can walk you through what your mortgage looks like and what that may look like in 6 months when your deal's coming to an end. Okay. And it's really about securing something early. So you don't have to wait to remortgage. You don't have to wait to the end of your fixed rate. It's something we can actually go in early and do. We can get you something secured with a new lender at sub 4%, what's out there now, for example, and have that locked in, ready to go.
Okay. How long would that last for then? Because you're saying 6, 7 months. Yeah. That seems a long time. Why? I know you're saying work proactively, but half a year is a long time.
Absolutely.
What's the time scale about there then?
Absolutely. So once you've got a new mortgage offer from the new lender you're remortgaging to, you'll have 6 months on that mortgage offer.
As an expiry date?
Absolutely. Okay, so it will be valid for 6 months, which that's why we say 6 or 7 months prior to the end. Yeah. So that will carry you all the way through and allow you then to revert from your existing lender, for example, to your new lender onto that new deal that we secured 6 months ago.
Well, my initial feeling saying, okay, so I do that 6, 7 months early. We take the late 3% deal that we managed to lock in. But then interest rates improve in that 6 month period. So why have I done it earlier? Should I not have waited?
Absolutely. No, so really great question. So that's a really valid question, because like I said earlier, that's something that a lot of customers will say. So what we have the ability to do is lock you in a new rate, get you a mortgage offer that's valid for 6 months, and track that for you. So if, for many lenders out there, if we lock in a deal and we get you a mortgage offer that's valid for 6 months, and then during that period, there'll be a cut-off to that, but during the next 4 or 5 months, if rates do improve and go down, we actually have the ability to switch you onto that. So the 3.99% or the sub 4% that we got you, if rates improve, we'll flip it and we'll get you onto the better deal if one becomes available with that lender.
So it makes good sense.
Absolutely. So twofold. You're locking in something early, which you're actually protecting yourself against losing the rate. Yeah. Because if rates don't go down, they go the other way. Yes. You've made a really, really good decision 6 months early. lock in and kind of secure that rate, but without affecting the ability to get something lower, because we can, as I say, we can flip you onto a better rate if one becomes available.
And from working with an advisor and a brokerage firm like yourselves, is the cost implications then to look at it early and continue to service it? Are you going to charge fees throughout for all these changes?
Absolutely not. No, it's all about giving the customer the best possible outcome. Okay. And that's ultimately getting on the best possible deal that fits their circumstances. And it's the cheapest option, because it's all about getting the most cost-effective product.
Yeah.
Or cost-effective fixed rate, for example. So no, it isn't about charging a fee or charging administration. There's no administration cost to it. It's a case of, look, we'll track it, we'll keep an eye on it. If one becomes available, we'll make the necessary changes.
Okay. So anyone watching, of course, if you've got an existing mortgage and you're fearful that you're coming off a low rate, or you're just fearful that you're going to have to look into the market and find a new product, as you say, 6-7 months prior seems to be a wise elements of advice there that you're giving. So, if you do need support from ourselves, contact us at the office and we'd love to support with that.
Absolutely, sure. Yeah.
Okay, so we're going to really simplify mortgages now, because we might have listeners here that really don't understand what a mortgage product is. Also, we're talking about affordability. So I want to concentrate on these two areas now. So a mortgage product, we talked about fixed rates. I'm aware that that's the most common product for mortgages. Can you just explain how a product works and why a product lasts a period of time for a customer? Because I believe many clients that we've spoken to over the years, they didn't have an understanding that interest rate was actually going to expire after, say, 2, 3, 5 years. So you just elaborate on what we mean by products.
Yeah, absolutely. So products, there's several different products in the market, and you're absolutely right. A fixed rate tends to be the most well-known because it's the most common. Purely, I feel, and most of the time a client would select it for security, because it means that your rate won't move during a fixed period. Okay. And that fixed period could also be known as a tie-in period. Okay. That's probably a better way to actually describe it, because each individual product, whether it be a fixed rate, whether it be a tracker or a variable, for example, generally they'll have a tie-in period. So you'll have that deal for a set period of time. So the lender won't give it to you for 25, 30 years or however long your mortgage is. Okay. You've got to be on a product at any given time, which will last for a certain period.
So you're saying, let's say someone has a 25-year mortgage.
Yep.
They might take a 5-year product at 4.5%.
Yep.
And then in 5 years, they need to go back out to the market and look for a new product, for whether it will be for 2, 3, 5
Correct.
years.
Absolutely, yeah.
Okay.
Yeah.
And that gives them ability, of course, to then, coming on to affordability, to manage the expectation of the mortgage market, and which will then have a reflection, of course, on your monthly payments, or the ability to pay your mortgage off. Yeah. If that's something you want to do quickly.
Absolutely.
So if interest rates have improved, you want to take advantage of that.
Yeah, absolutely.
You want a new product.
Yeah.
So just finally, before we come away from that then, so you talked about, let's use a 5 year as an example. What if somebody has locked in on a high interest rate, rates fall down, and then after, say, 3 years, they're thinking, I wish I would have got a lower rate. Can they not come out of that deal?
Beauty of hindsight. Absolutely. They can. You can. So as much as it's a tie-in period, you are tied into that particular product. You do have the ability to come out of that product at a cost, potentially. So what that means is that if the lenders are going to give you a product and tie you in and secure that and fix it for a certain period, for you to be able to come out of that, they're likely going to charge you a fee. Yeah. And that fee is usually it's like a penalty. So it's an early repayment charge. Okay. Now the early repayment charge it all depends on how far in to a tie-in period you are. So you use the example where you've got someone on a 5-year fixed.
Yes.
They're 3 years in, so they may have 2 or 3 years left. The early repayment charge is calculated based on where you are in your time period. So for example, the earlier on in your time period, the higher the penalty, the back end of the time period.
My brain's ticking here now. So what I'm thinking is, surely that then is to really protect the lender from a profit point of view.
Yeah, absolutely.
Because if they've honoured a rate to you over a period of time, they expect you to remain with them.
Yeah, not just jump ship when things get better. Okay. Absolutely, yeah. So I suppose your question was that, can you come away from it and go on to a lower rate? There's nothing stopping you doing that. You can do that at a cost. So that's something that we could look at for you. We could say, right, you're on a 4.5%, for example, and in 3 years' time, maybe rates have gone sub 3, I don't know. Hopefully, fingers crossed, they do.
Sub 2.
Yeah, sub 2.1. Yeah. And if it is cost effective for you to do so, which means that if paying any early repayment charge would allow you to move on to a product that will save you more money than what the penalty is, then that can make financial sense. Absolutely. So sometimes it is the right thing to do in some circumstances.
Yeah. So what if someone doesn't want to pay that early redemption charge but wants to remortgage for another reason? So let's forget the interest rate. What if they wanted to remortgage because they wanted capital equity out of that property to maybe do some home improvements?
Yeah.
Or alternatively, they might have, had a number of different credit commitments that have built up and now they have a debt that they'd like to possibly get rid of because it's just a burden on them.
Okay.
So the mid product, we talked about having to incur that charge. What if they're on a rate that they like? What if they don't want to incur that charge? Is there any way of getting equity out of that property?
Potentially, yeah, potentially. So most lenders will offer a further advanced process, which is whereby you go to your existing lender and you apply to borrow more money.
Okay.
It creates essentially a bit of a sub account, so you end up with two mortgage accounts.
Understood,
one of your existing mortgage and then the additional borrowing that you take. You'll have to go back through assessment. You'll have to go back through affordability. So you need to be able to afford not just your existing, but the additional as well.
Okay.
But they may allow you to take additional borrowing with your existing lender.
So it's all about affordability.
All about affordability.
Yeah,
absolutely.
Okay. And what if that lender, let's say you're with a high street prime lender, what if they turn around and say no? No, is there other options?
There is. So there's something called a second charge.
Okay.
So to break that down, you've got a high street lender, like you say, you've got a high street bank who you have a mortgage with. They typically have the first charge on your home, which means the money they've lent you is secured against your property.
Okay.
And they have priority in regard to being paid back. A second charge lender would potentially lend you money that you require, like you say, it could be home improvements, could be debt consolidation, some other reasons we'll no doubt go into, but they would take second charge. So they would potentially lend you money and secure it against your home as a second charge, so second priority. Now, that type of borrowing is a little bit more expensive because it's a bit more high risk for the lender, as you can imagine.
Yeah.
They're not taking priority.
Yeah.
But it's certainly an option for sure. If the first charge further advance isn't an option, second charge is always something that can be looked into.
So in summary there, we're saying you keep your current mortgage.
Yep.
You borrow extra money elsewhere.
On top.
And you pay for two.
Correct.
So again, that affordability is so important.
Crucial.
And also to be sustainable long term, because mortgages tend to be long term commitments.
Yeah, absolutely.
Okay, great. So that brings us on to affordability. So if you're a first time buyer, existing homeowner thinking of moving house, if you're looking to remortgage and possibly borrow more money, or even remortgage on a higher interest rate for it to remain affordable, affordability is key with the mortgages, isn't it?
Yeah.
So at the moment with the current market or where we've come from, what are lenders looking into? Are they looking through fine tooth comb of your bank statements? What are they looking at? What is affordability with a mortgage lender?
Absolutely. So affordability is a common term that's used to assess how much the lender will lend you. And that borrowing amount that they're willing to lend is dependent on lots of different factors. So mainly it's your income that's used. Okay. So your earnings will initially dictate how much you can borrow. Okay. So the more you earn, the more potentially you can borrow. Okay. Factors that then go into that and affect borrowing, such as the term of the mortgage, how long you're borrowing over. Okay. Because if you're borrowing for a shorter period, the monthly payments are higher, as you can imagine. You're borrowing money, paying it off sooner. You've got to pay it back quicker. So
there could be a bonus to that, by the way, could there?
Absolutely. It's cheaper. Yeah.
Yeah. So you're going to pay less interest.
Yeah, absolutely. The longest mortgage isn't always the best option, for sure. So yeah, the term is dependent on your circumstances, for sure. But income is the main driver. Other factors that can affect affordability and how they assess it is debts. That's a big one. So if you've got, you could have any personal loans, you could have car finance, you could have credit card debt, which isn't a bad thing to have. I'm not saying don't have them.
Many have it.
Absolutely.
Yeah.
But it's specifically those those types of debts will affect the amount you can borrow. So having more debt will reduce the amount you can borrow.
Yeah. Well, it does make sense. You were talking about it being income based.
Yeah.
If you're already paying for things, you've got less disposable income
exactly
to use for your mortgage.
You've got less net income for sure. And you mentioned bank statements, and this is a crucial part of any mortgage application. Lenders will look at your bank statements, and so will we as a broker. We've got a due diligence to do. So it isn't about having squeaky clean bank statements and not spending any money for the last 3 months. It's ultimately having bank statements that tell the right story, and make sure if there's anything that's not too untoward in there. It could be large transactions that we just need to establish what they were, what they related to. And so they will look at them. So they will look at your habits and your spend.
I've got a question that's just come to mind then based on that. So what is a no-go? What if a lender's looking at your bank statement? What do they not want to see? And let's not go too dark. Let's keep it simple. No, what do they not want to see?
The biggest one would probably be gambling.
Okay.
Gambling's it's not so much a no-no, because you might be someone who, it gets to the weekend, you might watch a bit of football, you might watch the racing, and you might put a couple of bets on, and you might do that as a bit of a pastime, and that's absolutely fine. It's the consistency of it. How regular is it? Does it become a problem? Can the lender look at it and say, this is too regular, too often? So if something's happening daily, that can be an issue.
Because that could grow, of course.
Absolutely, and from a responsible lending perspective, the lender might look at that and say that's not something we may consider. So it's more the level of it. So it's not a big no-go, don't do it. It's how severe is it, how often and how frequent is it.
Brilliant. So just before we go away from existing mortgage clients, when we're relating to affordability, if we've got a customer that comes to us and says they're with the high street lender, they want to remortgage, but within the last product period, they've now got significantly more expenditure. They've got a lot of debt, but they don't want to remortgage and raise funds to clear. They're quite happy to manage it, but remortgaging with a new lender is just not possible. The affordability you've mentioned isn't there.
So they can't borrow the same amount as what's existed on their mortgage.
Correct.
Right. Okay.
Yeah. Do they have any option with the current lender or other lenders to prevent them reverting off that product? And if they do revert off that product, what happens?
Okay, yeah, great question. So let's stick with that for a second, because that's sort of what we've been discussing. So for example, you're on a fixed rate and it's for 5 years and you're coming to the end of that fixed rate. If you do nothing and you allow your mortgage to fall off of that fixed rate product or any type of product that you've been tied into, more often than not, you'll revert onto the lender's standard variable rate, also known as SVR.
Yes.
The SVR typically is very expensive. Okay. If you could imagine the base rate, for example, the Bank of England base rate is 4.5%.
Okay.
Typically, a lender's standard variable would be a good couple of percent above that.
Wow.
So you could be talking 7-8% in some circumstances.
Just stick on that point for a moment. That means there's likely people out there without that understanding of remortgaging and new products available that are sat on a standard variable rate without the knowledge that they can actually potentially, look for a new product.
Far too many people.
Okay.
Yeah. Listen, being on a standard variable might be right for you at that time. I'm not saying don't do it.
Yeah.
But there's far too many people on there that are in that position, like you said, Mark, that they just didn't know what they could do.
Okay.
They finished their fixed rate and they didn't know they could get a new product. So it's so crucial for them just to get in touch with a broker.
Okay, great.
And have that discussion.
Yeah. So just coming back to the point then, in regards to, they can't go to a new lender, the affordability is not there. They don't want to revert to this 2-3% above the Bank of England base rate, standard variable rate. What options are there?
So most lenders, not all, so we can't categorically say that every lender will do this, but most of your prime high street lenders offer a product transfer process. It could be referred to as a product transfer, a rate switch, product switch, as they're all ultimately the same thing.
Okay.
What that is the lender offering their existing mortgage customer a new deal without having to go back through an affordability assessment.
Oh wow. Okay.
Yeah. So it's an absolute fallback, and it's great to have. And listen, in some instances, the products that these lenders are offering their existing customers can actually be better than what another lender might be offering as a new mortgage.
Okay, yeah.
So it's always something that we would look at and explore to make sure, like I said earlier, best possible outcome, make sure the client's on the best possible deal. So if it isn't the most cost effective and it is a bit higher, I'm not guaranteeing you this, Mark, but it's certainly going to be lower than the standard variable. Okay. So that's always a bit of a fallback, is that we can get you a new deal with your existing lender without going back through that kind of assessment and application process for,
that's great,
for affordability. Absolutely.
So it prevents that significant hike, and you're talking standard variable, which means that could be fluctuating, going up and up as well.
Absolutely.
Prevents that. And if someone needs security, they can look for a new fixed product, as an example, which is then likely maybe a couple of percent, a few percent less than that standard variable rate. Yeah. That's really good. Yep. Okay. So, we've talked about existing mortgage clients. I think a key area this year is going to be first-time buyers.
Absolutely. Yeah.
We've come from a pre-pandemic to post-pandemic era with first-time buyer mortgages, where I believe there was actually some generous support from the government.
Yes, I agree.
Now, I'm referring to the Help to Buy scheme there, which is no longer available anymore. Yep. But as a previous mortgage advisor, I recently sat down with a client of mine that had a Help to Buy loan from the government that bridged essentially the gap and gifted an interest-free loan towards the deposit of buying their first home. Now, that was 20% of the property value at the time, and a property around 300,000. Right. That's £60,000 interest-free for 5 years. That client came to me recently and said they're thinking of relocating. So what that would mean is that Help to Buy loan would need repaying back to the government. Yep. And they would need to look for a new mortgage with new affordability based on current interest rates. And as you mentioned previously, they'd actually have to come out of the product early as well, right, incurring a redemption charge to leave a 1.41% interest rate. Wow. And it cost them over £6,000 to leave. So the conversation when I sat down wasn't the nicest conversation by means of the outcome, because of course it was, at the moment you're paying around £600 a month for a £300,000 property. And if you want to relocate for a similar property, you're looking toward £2,000 a month, because the Help to Buy scheme is no longer available. So they only have about a 5% deposit. They'd be on an interest rate now of about 4.5%. So for me, what that did for me, it made me really resonate with first-time buyers for 2025. Yeah. So what is the answer to buying, especially in an affluent area like Hitchin, the surrounding area of Stotfold, Letchworth, Fairfields, Cambridgeshire, property prices still significant. So first-time buyers, Cade, what are we going to do?
What are we going to do for them? It's tough. It's a really tough first-time buyers, because I speak to many first-time buyers, and it could be a scenario where they've got good income and affordability is great, but they haven't got a deposit. They haven't been able to get enough deposit because the property value, like you say, especially in certain areas, the property values are so high that the actual deposit required, even if they're going in with the minimum deposit 5%, for example, that 5% is such a big figure in actual pound note value.
You were saying the minimum deposit currently is 5% of the property
purchase price.
Okay,
correct. Yeah. So if you're buying a property, for example, 500,000, 5% would be 25,000.
Good math.
Thank you.
I was thinking you might.
I chose an easy number. However, there is a caveat to that with deposits, and we've got options in the market with certain lenders who are offering even further support for first-time buyers.
Okay, great.
Where you can obtain a property and a mortgage with as little as 1%.
Wow.
1% deposit, or £5,000 as a minimum. So this could be a 99% mortgage. So there's options out there. So this is going back to what you're saying there. Where's the support? Is there support for first-time buyers? Absolutely. So if deposit's an issue, we've got options out there potentially with lenders who would look to do it with such a small deposit of £5,000 or 1%. So
I suppose where the brain goes then is that the smaller deposit you have, the bigger mortgage you're likely going to require. So because again we're looking at properties, 300, 350 plus, that's a significant loan for people. Yeah. So we talked about it was all about income, disposable income. We're talking about multiples of salary. Mm-hmm. Is there any support out there in the current market to give them more, help them out?
Yeah, absolutely. So let's use the example where someone, you've got first-time buyer who may have a deposit. They may have a deposit from savings. They may be getting a gift from parents. Lots of different circumstances. We see a lot of that nowadays, where maybe their income isn't stacking up and that the affordability is a problem and they can't borrow enough to buy the house they want. Yeah. So there's lots of support out there with first-time buyers and with lenders. I'm talking high street lenders that are offering an enhanced affordability assessment. Okay. That's quite wordy, isn't it? But ultimately,
great word.
Yeah, great word. It's a boost, essentially affordability boost.
Okay.
So they will lend you, in some instances, up to 33% more than another bank. Wow. Because you're a first-time buyer.
And I presume that's not irresponsible lending. There must be some elements of criteria.
Yeah, absolutely. I was going to throw it at you. Yeah, absolutely. Yeah. So there are certain caveats to that in regard to criteria. Certain level of income you may have to have. It could be the lender would specify that you'd have to take a 5-year fixed rate, for example. Okay. It could be property restrictions around that potentially as well. Absolutely. But it's great. I've used it several times, many times, and it's allowed first-time buyers to go to market when they thought they couldn't.
I suppose what this does, it really confirms the importance of advice. Sitting down with a mortgage advisor, it's not just what you can see. Mortgage advisors have got many different options, and I've always used the saying, they can kind of solve your riddle.
Yeah.
They can look at paint your picture, shall we say, of what your circumstances, your lifestyle from an expenditure point of view, your income, what you're looking to achieve moving forward. And then I suppose everyone's circumstance is different, isn't it?
Absolutely.
And I suppose that's the joy also of being a mortgage advisor. Yeah. Keeps you on your toes.
You certainly see, all different circumstances. But second on that is that, every person's circumstance is different. And additionally, every lender's criteria is different. So you may think, oh, I bank with X lender, so I'll book an appointment with them and go and see them in the bank.
Okay.
And what you're not getting is you're not getting advice based on all the options out there that could be right for you. You're alienating yourself potentially to one lender's criteria, one lender's affordability assessment, for example.
Understood.
So if they can't lend you what you want, you might walk out there feeling a little bit disheartened, think, we can't do what we wanted to do. Might not be the case. So you're absolutely right.
So when computer says no, with the bank you bank with, it doesn't mean no.
Correct.
By means of looking at the mortgage market. Absolutely. Because again, it's about solving your riddle. It's about putting you in the right place with responsible lending that's affordable to you, but gives you the opportunity to maybe find a new product, maybe get onto the property market as a first-time buyer, or even move home.
Yeah, move home. Absolutely, yeah.
Okay, fantastic. So first-time buyers, just to kind of in summary with that, is that we need a 5% deposit.
Yep.
We need an income to pay for the mortgage, but there is, I suppose, support available with lenders that it's unique for first-time buyers to assist and help you get them first steps and get you
exactly
in the property.
Exactly that.
Okay, that's really good to hear. So Cade, you deal with many first-time buyers. I'm sure if any first-time buyers listening, reach out to Cade at the office.
Please do.
We'll get an appointment booked. Also, as well, a lot of people's perception of a mortgage broker is that it's going to cost you something to come and sit down with a mortgage advisor. Yeah. It doesn't cost you anything to sit down with an advisor. It shouldn't, shall I say? It doesn't afford you
with us, it doesn't. Yeah.
It shouldn't, in my opinion. Let's say. But come in, no obligation, get some advice, and even if you're really early within the process, we talked about being proactive with an existing mortgage client. If you're not even a mortgage holder, you're not even a property owner, and you want to be, well, at least plan ahead, understand what the options are, and if there isn't any options, understand what you need to do to get to where you want to be.
100%. You could be in a position where you've been saving a little while for a deposit as a first-time buyer. You might not think you're where you need to be. You might not know where you need to be. And that's something we can absolutely sit down and go through and kind of build a bit of a plan around, this is what the mortgage looks like. This is your affordability. This is where you need to be in regard to a deposit. And you can go away from that and achieve them goals and get to a position where you might be mortgage ready, for example. So the earlier the better.
I know we talked about different profiles of clients, and we're talking about income being really the main source of the ability to obtain a mortgage. One main profile that we come across is, the occupation type or the employment type. So you could have people employed within new roles. You could have people employed that have been in a role for many years. You could have self-employed, contractors.
So many,
directors of limited company, shareholders. There's many different income sources that I'm right in thinking there's potential to use?
Yeah, absolutely. And there's a bit of stigma around certain, people think who are self-employed that they're not supported with mortgage lenders. Not the case. It's just understanding how they assess it, and what the income is that we can use and use toward affordability. So, like you say, there's several types of income and occupations and contract types, but there's options out there. Lenders have different appetites, I suppose, is probably the word to use.
Great word.
Some lenders, will be heavily sort of supporting, standard employed contracts. Some lenders will have a really big appetite for fixed term contractors or self-employed applicants. So it isn't one size fits all. So again, speak to a broker. We've got access to all those criteria and lending options.
You've got answers.
Answers, yeah.
That's really good to know. So now, I suppose the final client type that I'd like to discuss today, away from existing mortgage clients, away from first-time buyers, is existing homeowners that are looking to potentially move house.
Yeah, okay.
So you've got an existing mortgage, and it could be within a product tie-in period. Also, it may be that you're coming to the end of that product tie-in period, and you're looking to, let's say, upsize, as an example.
Okay.
How's the market looking, and what kind of feeling are you getting from, you mentioned estate agents earlier, for 2025, Q1 of 2025? What's the vibe for home movers? Is it a good time to be moving? I know you can't answer that, that's got to be an opinion again, but what's the feeling?
I'm going to use the phrase demand, because demand is essentially how many buyers are out there, whether you're a first-time buyer, home mover, whatever it be. What's the demand? And the demand's high. That's what we're seeing. People do want to move home, but we're just seeing there's not enough stock, I suppose is the word they use. There's not enough houses on the market. So the demand's there. We just need more houses. So I think it's a really good time. I think we'll see a lot more people come into market looking to move home and kind of getting their house on the market to sell, and feeling like the time is right. So yeah, it feels good. It feels like it's going to be a busy year, I think.
Great. I actually bumped into a couple of friends in Hitchin Town Centre last week who were looking to downsize, actually. And it is exactly that is what the problem is that they're able to sell their house, but when they go out there looking at what is available at the moment, there's not a lot. They've looked at affordability. They've got the mortgaging potential if they need that, but just the property isn't there.
Exactly that.
So I suppose that's just a matter of a waiting game, isn't it? Is that the only answer?
Absolutely, it's a waiting game. Have a chat with some local agents, get more of a feel for the market. Have a chat with us, to discuss your finances around it. What's actually your ability? What is it you want to achieve from your home move? You're downsizing, you're upsizing, affordability, like we discussed, and supporting you through that.
Understood. So one thing I want to quickly touch on is stamp duty. We're not tax advisors. If you really want advice around tax, you initially need to speak to a tax specialist or an accountant who can do that for you. Also, your conveyancer within the process of buying a home will definitely they'll be able to kind of hold your hand by means of the tax implications of either buying your first property or moving home, selling and buying your new home as well. Stamp duty is something that is created some energy, shall we say?
Energy is a good word. Energy. I like
early 2025, because I believe it's changing.
It is. They're making some changes from the 1st of April. So these are changes that a lot of clients that I speak to are pretty much aware it's coming. So there's going to be a busy March. Put it that way, I think, for a lot of customers and a lot of solicitors.
So just to double check, what you're saying there is that the change is negative beyond the end of March to April.
Correct. Yeah.
So if people can exchange complete pre-April, it's advantageous to
absolutely
do that.
So you'd need to complete on the house purchase by the 31st of March, and if you don't, and you complete after that date, you potentially could be paying more stamp duty, depending on your circumstances and depending on the purchase price.
So I suppose it's some important advice, I suppose you would say to people listening, is that we're talking about affordability. You've got to look at the bigger picture. It's not just your deposit. It's not just your ongoing monthly payments. It's what is the overall cost of being able to move home, buy your first home, and factor everything in and make sure it is the 100% the right decision now, or again, is it better to plan for the future?
Absolutely. And you mentioned earlier about first-time buyers. Is it the right time? And now is probably the right time to get some advice because of the stamp duty changes that are coming in from effect on the 1st of April. There are some changes that are affecting first-time buyers as well as home movers. So really want to, if you're in that position where you're thinking about moving, buying your first house, come and have that conversation because we can walk you through that and let you know what that looks like post the 31st of March and how that's affecting first-time buyers as well. Brilliant. And making sure you're factoring in those costs, like you say, additional stamp duty potentially, solicitor fees, things like that, and we can really assist with that.
That's brilliant. Okay. And I suppose the last thing is, I mentioned it, we talked about products, we've talked about tie-ins with products.
Yeah.
If someone's sat at home at the moment thinking, we'd love to move home, but we're fixed for 5 years.
Yeah.
Can they still move home without incurring that redemption charge?
Great question.
Because I see it as, especially if they're on a 2.5%, 3% deal, they don't want to lose the rate they've secured.
Yeah, absolutely.
They don't want to pay thousands of pounds potentially as a percentage of the current loan to move home, but they'd love to move.
Yeah. And they may just sit there and go, we can't because we're tied into a deal for the next 3 years.
Yeah.
Yeah, absolutely. Potentially, they can still move without incurring a penalty.
Okay.
And this is something that will be dictated by your lender specifically. Okay. And what I mean by that is that within your mortgage terms and conditions you have within your, for example, we keep saying fixed rate, we'll still use that example. Within the fixed rate terms, within the mortgage contract, you may be able to port your mortgage.
What's that mean?
Yeah, that's what most clients say that when I say
it sounds like a nice drink at Christmas.
Yeah, absolutely. So is your mortgage portable? So what that means is, will the lender allow you to take your mortgage to a new home? Yeah. So essentially transfer is probably a better word to use. Can we transfer your mortgage from this property to that property? Now, you have to qualify for the mortgage. So you have to essentially reapply, pass criteria, credit check, affordability, as you would with any mortgage. However, what you can potentially avoid is paying that early redemption penalty. So if you've got a great 1.48%, like for example, you may be able to pick that mortgage up and take it with you and put it on the new home. And if you then potentially need, if you're upscaling, for example, and you need more money to buy a bigger house, you could potentially then apply for more money with your lender as well on a sub account like we spoke about earlier, like a further advanced scenario. Yeah. So you could port your existing and take additional borrowing potentially as well.
That's really good advice. And I suppose what that does for people, if you are listening and you're thinking you want to move house and you think, you've got to wait, but there's a property there, obviously it's tough at the minute with property, but there's a property that you have a real heart set on.
Yeah.
And again, get some advice on how that can be done. Because there's potential to be able to
because it's rare.
Get that wrapped up for you.
Yeah, exactly. And it's very rare that you'll ever time it right, that you'll move home when your fixed rate ends. That's really difficult to time because it's not really in your control when you complete or move home. So this portability feature with most mortgages do have them. There's some don't, but get in touch and we can absolutely get the answers. It provides you a massive opportunity to not sit and wait, for sure.
I'm going to end on a couple of things you hear in the news a lot at the moment. Bank of England base rate,
yes,
and all this talk of inflation.
Yes.
So we've talked about fixed products.
Yes.
Bank of England base rate. Does that affect them?
It can.
Okay.
It can. It doesn't directly affect it.
Okay.
Because there's lots of things that a lender and a bank will take into consideration when pricing their fixed rates.
Okay.
Bank of England base rate is one of them. There's lots of other factors. But the Bank of England base rate is very much there to drive the economy. Okay. And you would have seen recently that the Bank of England reduced the base rate down to 4.5%. So it's a really positive move. It may not mean that fixed rates automatically drop by the same percentage, but what it does do is it gives a better forecast for the mortgage market going forward.
It definitely creates a nicer vibe, an energy we talked about earlier.
Absolutely.
I feel like there's a lot more positivity as the base rate reduces as well.
Exactly that.
So if you're an existing mortgage customer and you're on a fixed deal, what we're saying there is then it's not going to benefit you, that base rate drop.
No, it's not.
So what type of mortgage is the potential for you to benefit from a reduction of the base rate?
Okay, so any mortgage product which has any link to the base rate. Yeah. So that could be, for example, we spoke about standard variable rates. Now, a standard variable rate isn't directly linked to the base rate, but typically when a base rate goes up or down, the lender will adjust their standard variable
rate. It's the control of the lender. That
correct.
Is it?
Yeah. Okay. So it's not directly linked, but it's reflective of reflective of what the base rate's doing. So that may go up or down when the base rate gets changed.
There's no guarantees though.
No, there's no guarantee.
Is there a product that is linked to the base rate then that does give guarantees that, you know, if someone looks for an alternative product and they're positive from their perception, of course, advice of the mortgage advisor that the base rate is going to continue to drop, is there a product that's linked to that?
There is, yeah. Okay. So this is called a tracker. Okay. So it kind of does what it says on the tin there, really. It tracks the Bank of England base rate. So it does what it says. So if, for example, we've got the base rate currently today at 4.5%, the lender will offer you a tracker, not a 4.5% sadly, but they'll offer you a tracker that's fixed above the base rate. So they may set it at 0.5% above base, for example. Okay. Don't take that as gospel. It's not exact rate.
No.
But other rates are available. So if they're offering you 0.5% above base, and the base is 4.5, 4.5 and half is 5. Okay. So you'd have an overall pay rate of 5%.
Yes.
That 0.5% that the lender's offered you is essentially fixed. Okay. That's fixed for a period, typically 2 years with trackers. But then, as it tracks the Bank of England base rate, if the base rate drops, then your overall 5% will go down. So your 0.5% remains the same, but if the rate goes from 4.5 to 4, for example, your overall rate goes down. So yeah, if you're, a bit more
risk averse,
if you're a bit more risk averse, no, not for you. If it's something you want to look at and you feel like you're trying to get ahead of where the market's going, and you feel like rates are on their way down, and what the Bank of England are forecasting with further rate drops, it could be the right product for someone. Absolutely,
and especially if money's not tight. If money's tight month to month, we find that most clients
for sure
really need security of payments.
For sure, and that's what the fixed rate gives you, right? It gives you fixed mortgage payment that doesn't change, whereas the tracker is a type of variable in that it can change, so it's a lot more risky.
Inflation.
Well,
inflation was around 10%.
Wow, would you believe it?
All I'm hearing now is inflation's back down to around 2%.
It's nearer the 2%, which is the target.
A positive vibe.
Yeah, absolutely. Yeah. And the economy grew as well. I don't know if anyone saw that in the news, but back end of last year, the economy grew slightly, which was a surprise. So economy's growing, the inflation's coming down nearer the 2% target, and mortgage rates are coming down. So yeah, all in all, that's one of the first topics we touched on. It feels good.
And I think that's where we're going to end today on 2025 is a feel-good year.
Good finish.
Maybe a good name for the podcast for today as well. So I want to say thank you firstly. For
pleasure. Thank you very much for having me.
We'd love to get you back on to talk about maybe some investment mortgages, buy-to-let properties.
Yeah.
The rental market at the moment is absolute chaos. There's absolutely no properties available.
Yes.
Without the odd exception, shall we say?
Absolutely.
So buy-to-lets is something that investors possibly want to listen into. So we can get you back onto that.
More than happy to. Look forward to it.
Thank you for your time today.
Thank you very much.
What we do at the end of every podcast is we ask the guest for a charity, because we're going to make a donation as a thank you for you coming onto the show. Okay. So I put the pressure on you there. I didn't know
there was coming, that. Yeah, brilliant. I'm going to go with Mary Curie. Okay. If that's okay.
Yeah, great charity.
Right. Yeah. It's one that's pretty close to my heart, so yeah.
Brilliant. We'll get that done for you.
Fantastic. Thank you very much. Thank you very much. Appreciate that.
Of course, if you're watching on YouTube or if you're listening on Spotify, Amazon Music, don't forget to subscribe, follow, like the post, even give us a comment. If you've got any questions, please pop them in the comments.
Yeah, absolutely.
And we'll come straight back to you.
For sure.
Kate will give you advice, professional advice. And of course, if you do need an appointment to speak to a mortgage advisor or a Fortune Financial, you can have appointments via phone, Zoom, face-to-face on Bridge Street in Hitchin at your convenience. And we're pretty much round the clock to kind of cater for your needs as well. But it's been a pleasure.
Thank you very much.
Thanks a lot.
Thank you.
See you soon.
See you later. Cut.
Well done, mate.
Thank you.
That was good. Why don't you press record?
Imagine.